One of the hallmarks of the cooperative business model is that the business is financed by the people who use its services. Additionally, because the cooperative is owned by user members, the profits or surplus of the business are shared with those owners. In a co-op, these profits are shared according to the members' use of the business, or how much they patronize the business, rather than their level of investment. This presentation is meant to give an easy, accessible overview of co-op patronage. Because this topic can get complicated, I recommend reviewing these materials various times and reading some of the additional materials in the co-op library. Also, as always, these materials are meant as learning tools, so always consult a professional when making decisions about a co-op's finances. As stated in previous presentations, the principles of cooperation impact the financial aspects of the business. Keep in mind that co-ops are organized to benefit members, not to maximize profits. That means that returns on investment, like preferred stock, are limited. That also means that co-ops should be financed by the people who use it. Because the people who use the co-op can and will change over time, the burden of financing the co-op's operation should also change over time with those membership changes. As discussed in previous presentations, co-ops can raise capital to start or operate the business from direct investment, debt, and other sources. We thought previously about these sources for new co-ops, but existing co-ops can also use these mechanisms to capitalize ongoing operations or expansions. Operating co-ops can also use additional mechanisms to help finance the co-op, namely retained profit or surplus. This chart from the USDA publication, Co-ops 101, is helpful for thinking about the sources of equity capital for a cooperative. We talked previously about direct investment in the form of stock or membership fees. In this presentation, we'll focus on equity capital that can come from ongoing operations through margins and per unit retains. Let's think about margins first for the case of a marketing cooperative. The cooperative purchases the product that their members produced, aggregates the products together, perhaps adds some value to those products, and then markets them to a wholesaler, processor, consumer, or other user. The co-op's goal is to earn money from those activities that cover the cost of purchasing the products, as well as the activities to add value and sell the products with some additional money left above those costs. The co-op's goal is to generate income above the cost of goods and other expenses in order to realize a net margin. Those net margins are then either invested back into the co-op or shared with members based on their use of the business as a patronage fund or dividend. You can see an example on the slide. The co-op has a gross income from selling products of $100,000. The goods they sold cost $80,000, and the co-op incurred other expenses to sell the goods for $10,000, resulting in a net margin of $10,000. Another method for a co-op to raise capital from ongoing operations is a per unit retain, which is a deduction from the proceeds of sales based on the value or quantity of the products marketed for a patron. For instance, a co-op marketing livestock may deduct a set dollar amount per animal that they market through the co-op. Often, per unit retains are used by co-ops as a method for building capital, such as working capital or to build a reserve for special use. The per unit retain is often treated by the co-op as equity or debt contributed by the member. Per unit retains are only used by marketing cooperatives. Unlike patronage refunds, per unit retains are not based on the net earnings of the co-op. They're based on the physical volume or dollar value of the products marketed through the co-op. Let's take a closer look at patronage refunds. Again, Patronage refunds are based on the net margins of the co-op. Let's start with the definition of patronage refund from the Internal Revenue Service. A patronage refund, or what is also sometimes called a patronage dividend, is an amount paid to a patron by an organization to which Part 1 of this subchapter applies. 1. On the basis of quantity or value of business done with such patron. 2. Under an obligation of such organization to pay such amount which obligation existed before the organization received the amount so paid. And 3. Which is determined by reference to net earnings of the organization from business done with or for its patrons. There are a few important pieces to this definition. First, note that the definition refers to patrons. A patron is anyone with or for whom the cooperative association does business on a cooperative basis. So, a patron can be a member or a non-member of the co-op. This means that a co-op could, if they so choose, pay a patronage refund to a non-member. Second, an organization to which subchapter 1 applies is an organization operating on a cooperative basis. So it's helpful to understand what it means to do business on a cooperative basis. Based on a specific legal case about worker cooperatives, the court outlined 3 core aspects of operating cooperatively for tax purposes. In Puget Sound Plywood versus Commissioner, they found that 1. Subordination to capital, 2. Democratic control by the members, and 3. Allocation of margins on the basis of patronage classified you as working cooperatively. Finally, this information is important to co-ops for multiple reasons, including determining how to allocate profit or surplus, but also because those allocations through patronage refunds are subject to single taxation. Note that this definition of patronage refund helps illustrate an important point about co-op finances. It's vital that co-ops keep accurate records of business transactions in order to share profits based on patronage. The co-op has to track the amount of business it does with each patron based on either quantity or value of business. View the financial records portion of Co-op Mastery to learn more about the importance of co-op financial records. So now that we know what a patronage refund is and what a per unit retain is, let's review the ways that a co-op can share the refund or retains with its patrons. The co-op can pay a patronage refund to members as cash or as additional equity investment in the co-op. Remember our helpful chart from a few slides back. The way a co-op shares this refund has tax implications for both the co-op and the patron. Read the definitions below on the slide. When a written notice of patronage refund or per unit retain is issued to a patron, it's either qualified or non-qualified. The amount of a qualified notice can be deducted by the co-op from its income. To qualify a patronage refund, the co-op must pay at least 20% of the patron's patronage refund in money or qualified check, and either the patron has the option to redeem the notice within 90 days for money, or the patron has consented to include the value of their notice in their taxable income. To qualify a per unit retained certificate, there is no requirement for what percentage as a cash distribution. There is a requirement for consent by the patron to include the value of the certificate in their taxable income. The chart is helpful for understanding the ways that the net profits of a cooperative can be distributed and the tax implication of those distributions. Net profits can be used to pay dividends to preferred shareholders, in which case both the co-op and the shareholder pay income tax on the income. The profits can also be placed in an unallocated reserve, where they're not credited to a member patron and are retained and reinvested in the co-op. The co-op is responsible for the income tax on those retained profits. The profits can also be allocated to patrons and paid through a patronage fund as cash, qualified written notice of allocation, or a non-qualified written notice of allocation. Both written notices of allocation are equity investments in the co-op by the member, and the funds are invested in the co-op. The member is responsible for paying the required income tax on qualified written notices of allocation, while the co-op is able to deduct the amount from the notice from its income. However, the co-op is responsible for the income tax on non-qualified written notices of allocation. Upon future distribution of the equity, the member or patron is responsible for paying the taxes on the amount, and the co-op is able to receive a tax credit for the amount. All of this ensures that patronage refunds receive a single tax treatment.